central banks continue to buy a lot of gold, especially non-Western central banks. They've bought 1,000 plus tons in the last 3 years, 2022, 2023, 2024. And with de-dollarization continuing, I don't think that's going to stop. So the setup for gold is still great, in my opinion. So this is the best time as well to be looking at companies that own large known deposits of gold in prime jurisdictions. The setup couldn't be any better. And I think patience, though, is something that we need to consider.
MarioInnecco, veteran macro analyst and longtime advocate for sound money, just laid out one of the most compelling bullish cases for gold, and more importantly, for the massively undervalued junior mining sector. Mario highlights how even traditionally bearish institutions like JP Morgan now call for $4,000 gold by Q2 2026. That alone should raise eyebrows. But here's the twist. While gold has surged more than 75% since 2011, the GDXJ, an ETF of junior gold miners, has declined over 60%. That disconnect is where Mario sees a once-in-a-generation value opportunity. Legendary investor John Paulson agrees, having just acquired 50% of Alaska's massive Donlin gold deposit for $1 billion. Meanwhile, central banks, especially in the East, have been on a buying spree, over 1,000 tons in each of the past 3 years. This is no longer about speculation, it's a global repositioning. With de-dollarization accelerating, sovereigns are choosing gold. Mario also draws on history. During the 1970s bull market, gold made 209 all-time highs, and from 2001 to 2011, 106 more. In the current cycle, from 2020 through April 2025, we've already seen 74 all-time highs. And yet, the mining sector continues to lag badly. That's not sustainable. Even more alarming, major gold discoveries have dried up. Since 2010, only 29 new deposits have been found. Global production is projected to fall 17% by 2030, and mines are depleting faster than they're being replaced. The bottom line? The setup for gold, and especially junior miners, is the strongest it's been in decades. But Mario warns, you need patience. We're still early. Now, we present the clips of MarioInnecco's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The bullion banks, the Wall Street banks that are usually bearish on gold, they're even bolder about the future of gold. Recently, JP Morgan said they see the gold price reaching 4,000 by the second quarter of 2026. And the last major bull market for gold related companies occurred more than 13 years ago. And here we are above $3,000, while gold has appreciated 75% since 2011. The GDXJ has depreciated by 63%. So that's where I think the value investing opportunity lies. That's my opinion. It's only a matter of time until the junior miners, exploration companies catch up. And this past month, legendary hedge fund manager John Paulson agreed to acquire 50% of the undeveloped Donlin gold deposit in Alaska for $1 billion. So there is some M&A activity starting in the sector. Well, the other thing I would point out too is that central banks continue to buy a lot of gold, especially non-Western central banks. They've bought 1,000 plus tons in the last 3 years, 2022, 2023, 2024. And with de-dollarization continuing, I don't think that's going to stop. So the setup for gold is still great, in my opinion. So this is the best time as well to be looking at companies that own large known deposits of gold in prime jurisdictions. The setup couldn't be any better. And I think patience, though, is something that we need to consider. The bull market in gold is still, in my opinion, raging. It's going to continue. We haven't seen half the amount of all-time highs that we saw in the 70s since 2020. We're seeing, of course, the mining sector the junior exploration mining sector lag way behind bullion. And yes, XCap is trying to capitalize on this, and they're focused on re-rating the value of this project in Nevada, the Converse project.
MarioInnecco explains that the gold price has logged 180 new all-time highs over the past 25 years, with a 10 times gain from its 2001 lows. Yet junior miners remain in a historic slump. Why? Underinvestment. Since 2010, global exploration budgets have stagnated, and only 29 deposits have been found post-2010, with none since 2016. Meanwhile, gold production is projected to fall 17% by 2030. This supply crisis is a freight train heading straight toward a tight market. Smart capital, like John Paulson's, is moving in early. Companies like XCap are repositioning assets in prime jurisdictions like Nevada, aiming for re-rating as the bull intensifies. These are the signs of a sector bottoming. If gold leads, junior miners follow. And when that catch-up begins, the upside could be violent. Let's get back to the interview.
How many all-time highs these bull markets have had. And we're going to come to the opportunity after we look at this. So in the 1970s, there were 209 new all-time highs in the gold price. In the bull market from the early 2000s, some people pick 1999 or 2001 as the low. In that bull market until 2011, when gold reached 1920, there were 106 all-time highs. And since 2020, up until April 11th, 2025, there were 74 new all-time highs. There's probably a few more now. But with the fundamentals being so strong currently, even compared to the 70s, I think we're still in the early stages of the current bull market in gold. And I have to admit, having been stacking gold and silver as well since 2002, yes, I've benefited in that my holdings have kept up with inflation and more. But we're going to look at the mining sector, though. But before we do, just give you an idea of how well bullion has done and how much the gold exploration sector has lagged since around 2010. So while gold spot price has seen a collective 180 new all-time highs in the past 25 years. So if we combine the bull market of the 2000s and the current bull market, 180 new all-time highs. And the spot price has more than 10x'd. And for a century to date, the appreciation has been around 1,233% from the 2001 February low in 2001. The spot price was around $255. The same, of course, cannot be said about the companies that explore for gold and develop projects and operate mines. So the gold mining industry has faced a critical crisis over the last 15 years. So from 2010 to now, exploration budgets have stagnated or declined. Discoveries also have plummeted. For example, between 1990 and 2023, there were 350 deposits found containing 2.9 billion ounces, but only 29 have occurred post 2010, with no major discoveries since 2016. So in a nutshell, global gold production has stagnated with projections of a 17% supply drop by 2030. And existing mines are depleting faster than reserves are replenished. So this underinvestment in new deposits is a huge driver for a likely supply crunch. Mines are depleting, it's a fact. and there are no major new discoveries. That's another fact. So I think it's incredibly bullish for gold, notwithstanding all the other fundamental reasons like the debt and government spending, of course.
MarioInnecco is sounding the alarm quietly but firmly. Gold's bull market is not over. It's accelerating. Central banks are loading up. Production is falling, and junior miners haven't even left the gate. He's been stacking since 2002, not chasing headlines but preserving real wealth. Now, he sees a historic revaluation coming, especially for companies with proven deposits in safe jurisdictions. Mario says patience is key. This isn't about chasing tops, but recognizing that the lag in junior miners is unsustainable. As gold continues breaking records, capital will flow where the leverage lives. Share your thoughts on MarioInnecco's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.